All right, this is December 29th. This is a Monday night, 3-hour study session for life and health general topics. My name is Matt, and I will be your talk show host tonight, or I mean your study buddy, whatever it is. Again, we're going to start this 3-hour session with some life. Then we're going to do some life and health combined. And then we're going to finish the last hour with some live study or test questions that are going to be more like what you will see on test day. I'm actually going to end this particular poll. I'm going to try to get a pulse on who's here, whether you are a first timer or whether you have been in one of my sessions in the past. So I want to kind of get an idea of that. And again, this is such a short session. It goes really, really fast. So I try to keep them moving. I try to keep my silly stories to a minimum. But I'm sure I'll tell one or two because I can't help myself. I hope everyone had a great Christmas. If you're joining me for the first time since then, we did have a short 4-hour study session Saturday morning. It was a little 4-hour one. And then I actually did some pre-recorded stuff after that. And this week, tomorrow will be a normal 6-hour session that will start at 3 p.m. in the afternoon and go to 9 p.m. Eastern Standard Time. And then Wednesday and Thursday, there won't be any live sessions due to being New Year's Eve and New Year's Day. And then Friday, there's no live sessions, but Saturday, we're going to be back to a full 8-hour live session on Saturday. That starts at 9:30 a.m. and runs until 5:30 p.m. in the afternoon. Long 8-hour sessions. And those are my favorite because I can cover the most amount of topics during those sessions. So let's get started today, though, and we'll do some general life topics. Oh, let me check the poll here real quick. Did I do it? Did I launch it? Okay, we got about half and half, first timers and returning people. Again, I know these little short sessions were designed for study accountability. If you have a question, I see a raise hand. If you have a question, put it in the chat. If it was inadvertent, which usually it is, then I'll just give you a high five. So, but if you do have any questions, you can use the chat. In the chat box, if you want to see everybody's interaction, there's a little drop down that says host and panelist, and there's one that says everyone. If you want to see everybody's interaction, change that little drop down to everyone. And that's inside the chat box over there to the right. And then if you want study materials once the live session is over, then hold on, I'm going to answer Sean's question here real quick. That is where the email will be coming from. So can't remember what I was just getting ready saying. I lost my train of thought. Oh yeah, the little drop down, and then the Q&A if you want to get some study materials I send out. There's links to previous live sessions in there, link to our YouTube channel in there, and then some printable study guides as well that you can print and carry around with you everywhere you go. That will help you pass the exam the first time. And I don't have my tips and tricks up for passing the exam. Let me see if I can find those real fast because I don't use those enough. And this, since we do have some new people in here, I think they'll be generally helpful. Hold on. Let's see. Study session. Let's see. Tips. All right. Yeah, so we'll go over these real fast. We got new people in here. So these are just general tips to help you pass your license exam on the first try. I'm gonna skip this one. I don't really like that one. This one I think is really important. The read technique. This is about techniques for multiple choice question or multiple choice test taking, which is what the exam is wherever you are, all over the country. That's the same. It's a multiple choice exam. And the first thing you should do is read the entire question first. Make sure you understand what it's asking for. It may be asking for the wrong answer. So it'll say, like, everything is true about something except. So you're going to be trying to find what doesn't apply to the question. Eliminate the obvious wrong answers first. A lot of times there's one or two answers that just don't make any sense. So knock them out. iPhone, will there be any trick questions? Not really, no. But they will word questions so that it tests your knowledge. I don't really call them trick questions. So whenever they use traditional multiple choice, they use what's called STEM based, and they use scenario based. STEM based questions are, and we'll see these in the last hour tonight. It'll say all of these things apply except. So you have to find the thing that doesn't apply. So it means 3 of the answers will apply to the question, 1 will not, and that's what you're looking for. But as far as tricks go, no, they just might not give you all the information sometimes. So testing how much you have knowledge of the content. So that would be the closest thing that you would get to a trick. So I have Travis in here who recently took his exam. And Travis, in the chat there, would you say that there's any trick questions on the exam? I'll let you answer since you're probably the most fresh, having taken the exam. And then you can if you want, or you don't have to. But I would say, he says there definitely isn't, or definitely is. There's, so you're saying there. So okay, so he says they're definitely trick questions. Travis, I'm going to let you unmute and kind of share what you mean by that, if that's okay. Are you cool with that? Yeah, okay. So go ahead and share what you mean by trick questions.
Yeah, so trick questions, I mean, they fluff a lot of things up. So like that's how they kind of trick you. And also you have to read either it says accept or not or true, like because if you're reading the choices and then you forget that it's accept and then you choose the one that's like the correct one for that answer, they kind of trick you in that way. So reread the questions, read it twice, and go through the answers twice also. Um, you know, and well, for New Jersey, insurance, they fluff it up a lot. So, Matt, you could probably say that they do fluff some
Yeah,
up
yeah, no, I
and,
definitely agree with that. But
but yeah.
it's basically, as far as like tricking goes, it's not really tricking you. It's just you've got to pinpoint what part of the question is most important to the answers that they're giving you. So you guess you could view that as a trick.
Oh,
Um,
all the fluff can,
yeah,
make you rear off and think of something else where
right.
you just need to, just focus on what they're specifically asking you. That's how they kind of get you to, you know, trick you in a sense,
Yeah.
I guess you could say, because I've had a lot of questions that are very thought out questions
Yeah,
on my exams.
Bill's observation is good. Is they're moving vocabulary around.
Hmm.
They're changing the order of things.
Yes.
Yeah, so they, again, it's, so my ultimate, like, piece of advice is know the content backwards and forwards.
Hmm.
So meaning the what, the why, and then if they ask it from the standpoint of what is not right about this, you have to know that as well. So that's just about, having a deeper understanding of the content. So that was a good question though. And then, hopefully we answered it. I just, Travis is right, exactly what he's saying. I just don't, I don't view that as a trick. I just view it as a, you know, tactic, I guess you could say. But, definitely is tricky. So there you go. So, yeah. So, but, and the way, to kind of combat that again is reading all the questions, obviously eliminating the wrong ones first, analyze the remaining choices carefully. Hopefully you get it down to two and then you got a 50-50 shot, and then decide and move on confidently. So that's the read technique. And I really like that. And that's exactly how I approach multiple choice exams. This is how I do it. And I also do it quickly. I process things fast. I think the more I take practice exams, the more I see the efficacy or the importance of this one. Watching for trigger words is that in insurance, especially, insurance likes to use muted statements or reserved. Well, the technical term for them is qualified statements. Generally, usually, may, can, sometimes, or often. When it comes to life insurance, especially, not really, this really doesn't apply to health insurance. Health insurance is more term driven. It's more of just a straight vocabulary test, almost a history test in a way, because it's basically facts and figures, it's time periods, it's things like that. And I'll show you some of those when we in the second hour tonight, and I'll kind of explain what I mean by that. But the things that are usually wrong, now this again, specifically in life insurance, look for words like always or never in the answers. These are in the answers. All or none, must, and only. You can usually knock those out because those are absolute statements, and life insurance just doesn't operate that way. They kind of always leave themselves an out. If you ever played poker and you're looking for outs, that's what insurance does. Insurance uses qualified language so that it has basically an out. And then the exception to this is legal requirements. If you're doing state specific legal regulation, they can have these words in there, and it would be appropriate because they're laws. So they're more absolute than just general topics. And again, if you're just getting started with all this, don't get too in the weeds on all this stuff. Just take what you can out of what I'm saying. If there's something you really don't understand, try to join us for a longer form session. Maybe an 8-hour session on Saturday, because I'm able to more fully flesh things out. These 3-hour sessions, I don't have a lot of time. I got to keep things moving. So this is my unwritten rule. And the longer I do this, I think the more this is maybe going to apply perhaps 2 to 3, 4 times on an exam. So this is only as a last ditch effort. If you're really struggling with one, the correct answers often need more words to be completely accurate. So you may look towards the longest answer, especially if it's referencing laws in the answer. A lot of times it has to include those laws to make the answer fully fleshed out. The right answers might have the qualifying statements in there generally, usually, or in most cases. But I would only use this if you're stuck as a last resort, not a study strategy. So I've kind of studied this out, and people generally agree that it does have some merit, but you definitely need to learn your content. If you go into the exam and you just use this, you're not going to pass. So this is just as a last ditch effort. I don't like this one, so I'm skipping it. So this is another one that's really important, and it rarely ever fails. Is that when you're in doubt, choose the answer that best protects the policyholder. Um, and that would apply to like general life and health questions both. Um, it's insurance law, insurance guidelines are basically there to protect the policyholder. So look for consumer protection first. So find that answer that provides the most protection for them. Uh, know your definitions, policy provisions, riders, and exclusions are heavily tested on. And I will say this: one thing that when you guys, um, someone asked me, is the test really that difficult? Yes, it is it is that difficult. Um, depending, state to state, it's a little more difficult in some states. Um, it's a lot of content. It's an absolute ton of content. And in my live sessions, we don't cover, I would say we go a little further than the tip of the iceberg, but not much. So, that's why I want to, give you more tools than uh, it's different in every state. The questions on the test, there's 50 states and there's 50 different approaches to how the test goes. So I don't know. Illinois, they chop their test up into 4 different. So one of your tests might have 46 questions. So I can't, you have to go on your own state website and find out how many questions are on your test. And off the top of my head, I wouldn't know it because we have 16 or 15 people in here right now, and they're probably from 12 to 13 different states. So, and every state approaches this differently. Although, again, the core content is the same, and I cover general topics in here, so it's good for all 50 states. You do have to know kind of like your state's overlay for certain things. There's certain things that I teach your state might have a little bit different slant on, but I'm not going to lead you too far astray. West Virginia, baby. Yeah. So I haven't taken that exam yet, but it's on my list. I'm taking Montana's on Friday. So that's another thing that I do is I take state exams for fun. No, I'm just kidding. I get paid for it. And just to make sure that our content and our modules and everything is appropriate. And also that what I'm teaching in here is appropriate. So, because again, this is the only exposure I get to this content. When I schedule an exam, like I scheduled Montana for Friday, I'm not going to have any time to study this week. I have no live sessions on Wednesday and Thursday, but I will be working. So I have 2 huge projects to do for the websites. So I will be working, and so I'm not going to have any time to study. And I don't anyway. I generally don't. So the stuff I cover all the time, it helps. Yeah, hey, I appreciate it, Bill. It's a zero sum game. I don't have to pass it. I'm literally just doing it. Although me personally, if I failed, I would crumble away, and I would probably crawl into a hole for a little while. I would be, like I'm taking it Friday, and I got a live session on Saturday. I would probably be very low energy on Saturday if I fail on Friday. So, hopefully I don't. But I'm pretty confident. I haven't failed a professional license in, I don't know, 15 years. So I'm good. I'm feeling good. Um, State specific rules, free look periods, replacement regulations, and unfair trade practices vary by state. Your state has an outline. Every state has an outline. In fact, if you're with Just Insurance or YourInsuranceLicense.com, we have your state outlines in our test prep section after you go through the base material. The test prep section will have your state outline in there. I usually have one queued up. I don't have one today because I had to shut all my stuff down. But that's where you find the content. Now it's only an outline, so you have to go a little bit further to get the content that goes behind it. But you can do that, kind of create your own study materials and whatnot. And then remember, math is minimal. I only ever recall maybe two, maximum of three math questions. They will allow you to use your computer's calculator, but every math question I've had recently, I've been able to do in my head. It's all very simple stuff. Just know the formula. It's not complex math. It's easy stuff. This is common traps to professional license exam taking. Changing answers without a good reason. You can go through, flag answers that you're unsure about, and go back and review them. Do not leave them blank. Ever, ever, never, ever, don't ever leave them blank. If you answer something to the best of your ability, you have a 25% chance of getting it right on a multiple choice exam. If you answer nothing, you have a 0% chance of getting it right. So don't, you can flag them, you can re-review them. That's totally fine, but do not leave them blank. Don't read into questions too deeply. And again, like Travis was saying, which was good info, there's a lot of fluff. Figure out what it's actually wanting from you. Usually, there is a core concept that it's trying to get at. So you got to figure out what that core concept is and then brush away the fluff and then figure out the answer. If there's an all the above, I haven't really seen this on too many exams, but don't ever just choose all the above automatically. You're probably going to get it wrong. Don't leave questions blank. Don't spend too long on one question. Turn and burn. Move on. Go back if you have to. Trust your first instincts. Take the questions at face value. Verify all parts are correct. Look for that not and accept words on there. Always make your best guess. Flag and return later if you have to. The night before, light review only. Skim key concepts. No cramming, new material. Prepare everything. Have your ID, your confirmation, directions to the testing center if you're doing it in person. Set multiple alarms. Don't oversleep. We're all adults here. Get good sleep before 7 to 8 hours. A rested brain recalls things better. Then positive visualization. Cheer, yay! I passed. All right. Eat a balanced breakfast on the day of if you take it in the morning. Stay hydrated. Don't overhydrate. You don't want to have to pee in the middle of the test. Stay calm. Deep breaths. You've prepared for this. Don't psych yourself out. Don't get the yips. You got it. Make sure your testing center knowledge is good. Obey what they say. Don't tick them off. And then the exam tests what you know, not what you don't know. So focus on your strengths. Preparation plus strategy equals success. So it took me 30 minutes to get to this point. So we'll get into some content here. This is not what I want. That is not what I want. This is what I want. So we're going to get back to the basics here for a little bit. Then we're going to transition over into some life and health stuff. But we're going to start out with life. Let me check this poll real fast. We are about half and half new people. Welcome if you're new. And then if you're returning, also welcome. And I appreciate folks that come back. Travis, of course, I know. Bill, I know, has been here before. Carol, I'm not 100% sure. E. Corlett, Gretchen, those seem like new names. iPhone, no idea who you are. Isaac, that's a name that sounds familiar. Jesus, you're a multi-timer. Juan, I'm not sure. Latanya, I think you've been here before. Mrs. Clemens, sounds like my teacher's name. Now I'm all nervous. Nathaniel, I'm the same person who sent in the email twice on Saturday. I don't think I'm signed up, but my name is Kyambra. Well, welcome, Kyambra. Scott, you take your test noon tomorrow. Yeah, I got, you know what? My wife, she used my computer the other day. She took my sticky note off. So I lost my dates of who was taking the test when, because I had you written down. So, man, good luck tomorrow. We'll be praying for you. And then Carol is the same person who sent email twice on Saturday. Well, my brain doesn't work so good, so I don't remember that at all. So no harm, no foul. Nathaniel, he's been here before a bunch. But Shotgun, I'm not sure about that. Scott's definitely been here before, and no, Sean's been here before as well. So, all right, let's get into it. And again, if you guys have been here multiple times, we're going to be covering stuff that you've already covered before. The once I get to the after some of this stuff, we definitely will probably get into some stuff you maybe haven't seen before, but it's going to be life and health related. But we're going to start out with the basics. We've got some new people here. We got at least 7 newbies here, so they need this ground setting stuff. And I've heard from a lot of people that take their exam is that the repetition is basically what helps them. So it's not going to hurt your guys to hear this stuff again. And in fact, if you know, it may trigger something if you're taking it soon that you hadn't really thought about before. And then I don't know how good you guys listen. Sometimes you guys drive around in the car and listen to me. There's only so much you can glean from that. But here we go. So general insurance terms. So life insurance. This right here. This is literally my favorite presentation I do because it just has everything I want in it. So life insurance, a contract. That's what insurance is in general. It's a contract. So you got to know some general contract law between a policy owner and an insurance company. So the policy owner, insurance company, also known as the carrier, it provides a death benefit. That's another term you got to know. 2 beneficiaries, another thing you got to know. Upon the insured death, another term. In exchange for premium payments, another term. And it protects against financial loss due to premature death. Life insurance is a transference of risk. So you are transferring basically the responsibility of finances upon the insured's death over to the insurance company. They're going to take care of it, right? So that's life insurance. Premium, I don't know about you, but if you're like me, probably have a bill that's coming out soon. That's basically your premium, your car insurance. I realized not too long ago that I'm literally in the insurance business. I'm not in property and casualty, but I was grossly overpaying for my car insurance. So I found a new company, and this is the really stupid part, is that I basically went over to a broker and reran my insurance, and I got super way cheaper insurance with better coverage, and I ended up with the same company I already had, which I think is completely stupid, but whatever. I'm happy about it. I'm saving a lot of money. But my premium's coming up. That's the payment made to keep an insurance policy in force. It can be annually, semi-annually, quarterly, or monthly. The shortest amount of period that you pay is the cheapest because there's less administrative costs involved. The death benefit, also known as the face amount of your insurance policy, that is the amount paid to beneficiaries upon the insured's death. Bill says, so in life and health, do they also do car, home insurance, or is it separate? Life is its own thing. Health is its own thing. Um, I'm not sure if you're meaning like insurance itself or licensing. You're talking about licensing? If you're talking about licensing, it's definitely separate. It's definitely separate. And then just not sure I follow you. The one thing, can car and home fall into life or health. No, they're not. They're not the same. Although, here's something to keep in mind, though. That kind of brings up a good point. I'm going to bring this up so you can see it. No, that's a good question. Yeah, let me show you guys something here because this might help you not screw something up. I'm gonna use Illinois real quick. Insurance license outline. Use this one because it always comes up first. Easy to find. I think it's literally this right here. Yeah, so I do want to show you guys this because honestly, I didn't notice this at first, but every type of insurance is on these outlines. Okay, so you have to make sure they chop them up weirdly. So you got to look at your header here. So this tells you, like, for everybody that's testing in whatever state, this is going to tell you exactly what you're up against. So life general knowledge, product knowledge, terms and concepts, 50 plus and 5 pretest questions. So that's how many questions are going to be on your exam. Remember, but keep in mind, Illinois is weird. So then here's types of policies. Here's policy riders, provisions, and options. You have all this stuff that's underneath of it. Now, it's not expanded. This is just an outline, right? You've got to work to expand it or find content that expands it and explains it. Here's more. There's all this kind of stuff. But if you keep scrolling down, then you find life Illinois specific. Okay, so this is the rules and regulations for the state specifically. 31 questions. So it tells you how many, right, in the outline. And then it moves on to health. But this here, hold on. Yeah, so this is for health. So it doesn't bleed over from up here. This is the end of life right here. You got to kind of see how these outlines work. And then here's the health general, same thing. And then you keep scrolling down, accident and health. And when it says accident, it's talking about disability. Okay, so that's not car accident, that's disability. It's disability and health. So there's all that. Now, see, it goes hit this page. This is property. So you don't have to do anything with property, but it's on here. So there's property, and then here's property state, and then it's going to go on to casualty down here. That's auto. And then personal lines, general knowledge. This is back to homeowners. This is every. Yeah, now we're down to motor vehicles again. Public adjusters, all this stuff. All right, Travis, you got this, dude. I don't care how late it is, but holler at me. Let me know how it went, okay? But you got this. Everybody give Travis some good juju. He's basically 50 minutes away from taking his exam again. So yeah, look at all that good energy. All right. So anyway, just keep in mind, careful what you're looking at on this outline. It's got everything on there. So all right. Okay. So state outlines should be something you look at least once when you're going through this process, is your particular state outline. All right, let's see. Premium, death benefit, we talked about. Cash value. Cash value is applying to a permanent life insurance policy, also known as a whole life policy. And we'll go over those in more detail. The cash value of a whole life or permanent life policy grows tax deferred over time. You actually only ever pay taxes for insurance on the growth. So if you're paying premiums and your premiums build your cash value, you don't pay any taxes on that. But if it grows because it's in the insurance company's general investment account and it grows from there, then you could pay taxes on that. And I say could, that's a qualified statement. There's always an out. And we'll look at that real, maybe not tonight. I don't know what we're going to get into tonight. We'll get as much as we possibly can. But I'm my thoughts and prayers go with Travis because I know he's ready to pass this thing and move on. I've actually, if some people in here showed up a little bit early, and I was having a run up session with Travis, and I'll tell you why I was doing that and kind of give you an idea if you guys are interested. But he actually scheduled 3 one-on-one sessions with me. So, I'm always kind of here early anyway. And because he scheduled 3 one-on-one sessions with me, I gave him, free 45 minutes of my time. I have no problem doing that. Because again, he actually scheduled 3 one-on-one sessions with me. So I appreciate that. And a link to that is in the study materials that I send out. And some people, most people are getting them because they've already responded to me, but some people haven't. And again, I probably just ended up in your guys' spam folders. But I think I've answered all the Q&A. Again, if I don't have your email address, if you're new here, go down to the Q&A section along the bottom. You might have to hit the 3 little dots that say more and drop your email address in there. And once this live session is over, I will actually send you out a link to this live session and a link to some previous live sessions, some longer ones. There's actually an 8-hour that I send in there, and then some YouTube links to our YouTube channel where you can watch my videos. You can watch Justin's if you're really desperate. I'm just kidding. He's amazing. I watch his videos all the time to learn more. And then, the more you can do, the more tools that you use, flashcards, printable study materials, live videos, pre-recorded video, whatever you can do, whatever you do is going to help you pass your exam. So cash value on whole life policies, they can be borrowed against or withdrawn. So you can actually take loans out on them. Again, we'll talk more about that. The insured is the person whose life is covered by the insurance policy. They'll actually be named in the policy, but that's not always who owns the policy. Other people can own, like a spouse can have an insurance policy on their other spouse, or a company, a business can have insurance on, a member of their business, a key employee, or a co-owner. The policy owner can be different from the insured, which is what triggers the death benefit payment. The policy owner controls the beneficiary designation. They control the loans. They control the surrenders of the policy. That's what the policy owner can do. The beneficiary is the person or entity designated to receive the death benefit. It can be changed by the policy owner as long as they are a revocable beneficiary. And again, if you end up in one of my long sessions, probably won't get to it tonight because it's such a short session, but I have a very special teaching method for learning revocable and irrevocable. I'm going to do a short on that for our YouTube channel about trophy wife. So that's one thing that's in my plan for the new year. So many new things coming in the new year, and I'm starting the year doing this. I started these earlier this year, but I'm glad I'm going into this new year doing these from day one because this is my favorite thing to do. But the insurer, it's the insurance company, the company that issues the policy and assumes the risk, also called the carrier. And I appreciate you guys. There's a lot of people mentioning stuff in the Q&A. Gretchen, no problem. How do you schedule your state exam? Um, so we have a service for that on our website, my insurance or yourinsurancelicense.com or just insurance. Other than that, you just take that word that you put in there. How do I schedule my state exam? And then put your state name in there, say, and put that into ChatGPT or put that into Google and ask that question, and it'll tell you exactly how to do that. Usually, you just contact your testing center, find the one that's closest to you, and then you should be able to schedule with them. Rashaka already has your Texas life insurance. I have to get your health. Does the life health have similar questions as life? That's a great question, Rashaka, and no, they do not. Um, yeah, no problem. I've got your email address now, Rashaka, so I will definitely send you something. I had there's a live, not a live, but there's a pre-recorded one, 8 hour session that if you go halfway into it, in fact, I'll show you here on my email. Right here. Hold on. Let's see. Study session right here. It's this one right here that's listed as this is exactly what I'm going to send you. This previous 8 hour session. Now, I mean, you can watch, you won't want to watch the whole thing. If you go to the 4 hour and 30 minute mark of this video, it's 3.5 hours of health topics. So that's probably the most expansive one that I've done on health. I usually end up with a lot of I let's see, I did the poll, and right now it's half and half new people. I'm going to end this poll right here, and then I'm going to go back to the other one to figure out what everybody's tested for. When I started, it was 9 life only and 8 life and health. Now you would be my only health only person. And usually those folks kind of get left behind because I can't leave out the life only people. So it gets really tough when I have health only people. But tonight you're in good shape because the second hour I'm going to do some health topics. And then when I get into the live testing, I'm going to do it's a mix of life and health. It goes back and forth. Oh shoot, I lost my presentation. Where am I? I'm lost. I'm lost on Bleecker Street here. Where am I? There we go. Wait. Yeah, this is where I'm at. Did I not make it this far? Oh, okay. Okay, now I'm back on track. Back on track. Let me check the Q&A again real quick here, though, because there was a bunch of questions in there. Cool. All right. Yeah, so underwriting, the process of evaluating and classifying risk determines if coverage will be issued and at what premium. Risk is the uncertainty of financial loss. Insurance transfers risk from the individual to the insurance company. So, because I kind of want you guys to see this, the only type of risk that is insurable is called pure risk. If you're taking notes at home, insurable risk. The other type of risk is called speculative risk. Not insurable. Speculative risk is like gambling or the stock market or something like that. You're not going to get insurance on that. But pure risk is random. It uses something called the law of large numbers. Insurance companies want to insure a plethora of people, a lot of people, young and old. They want a good mix because that helps to mitigate their risks. It helps keep their risks down. And those are the two types of risk. Now, the next is apparel. Apparel is the cause of loss, death, disability, a fire, a car accident. That's the cause of the loss. Okay. Um, and life insurance, though, specifically heart attack, an accident, or cancer, whatever causes the death. Okay. So that's a peril. Peril is what triggers the death or disability. A hazard is a condition that increases the likelihood of loss. Okay. So there are three main types, and these are heavily tested on. They're on there. Let me tell you. So a physical hazard is a health condition or a dangerous hobby. I'm not gonna get off on a lot of rabbit trails tonight because I just don't have time in these 3-hour sessions. But I have two a friend and his sister. They're both good friends of mine. And my friend is a scuba diver. And then his sister went the opposite direction. She is a skydiver. They both have dangerous hobbies. Those are physical hazards that increase the likelihood of loss. And he asked me one time, he says, does my diving really, like, is that really considered a dangerous hobby? And I said, yes, of course it is. And I said, can you die diving? He said, oh yeah, there's 1,000 ways to die diving. I'm like, okay, you just answered your questions. Your question. It's definitely a dangerous hobby. It's definitely a risk. Then there are moral hazards. Moral is exactly what it sounds like. It is dishonesty, intent to cause loss. If you have a history of financial fraud, then you are not going to get insurance. Bill says roofing, dangerous hazards. Yeah, roofing, that would be a dangerous profession. Now, how dangerous professions are handled is a little different than dangerous hobbies. They're usually handled through what's known as rating. If you've ever heard of rating insurance policies, it means raising the premium amount. Basically, it's going to cost more. That might even still cover death due to a roofing, or they will make it an exception in the policy that you've got this death benefit and it'll pay out unless you fall off a roof and die. So that might be listed as an exception. So it can go both ways. I actually have a friend who's a roofer and he has life insurance policy and it's not listed as an exception. It's just an exceptionally expensive policy. That's what I'll say. And then the last one is, general construction, not so much. It might rate a policy if you're just a general contractor, because, like, I suppose some bad things could happen. But roofer specifically, but if you're just like a framer or like a drywall guy or something like that, I mean, you're probably just going to get rated, and the ratings they're graded. So you could be like rated a little bit, or you could be rated a lot. So, but yes, generally, yeah, construction is going to be handled a little bit different. Good questions, though. Your questions often trigger me to say things that I either forget about or I don't cover as much. So carry on. A morale hazard, okay? That's carelessness or indifference to loss. I won't get into the full story, but I was in an accident, and this was probably my most recent accident I was involved in. I got rear-ended a mile away from home, and that's kind of a saying that most car accidents happen within a mile of your home. I've had 3. And the last one was a 17-year-old girl. I was sitting at a stoplight and she smacked into my rear end going about 40 miles an hour. She didn't even slow down. I'm certain she was probably texting, even though she says she wasn't. And I'm like, man, you're just a really bad driver. Actually, when the whole thing first happened, it was so crazy because we pulled off the road. My car was still drivable, but it was in pretty bad shape. I pulled into a parking space, and then she pulled in. And when she pulled in, she ran into the back of a parked car in the parking lot. And the yeah, no problem, anonymous attendee. I will send you. Yeah, I understand. I understand that happens. Life gets tough, especially around the holidays. But yeah, I'll definitely send you over everything I possibly can. So thanks for being here. But anyway, she hit the parked car. Happened to be the front desk girl at the nursing home. We pulled into the parking lot, and it was a brand new Kia Optima. The girl walked out, and she was horrified. Um, I was talking to the 911 operator, and I kind of alluded before I got out of the car. I kind of alluded to the fact that the girl might be drunk. I mean, she was hitting everything that wasn't nailed down. And then when I got out of the car, I turned the 911 on the speakerphone. They were talking to me, keeping me on the line, waiting on the officer to arrive. And then she said out loud with the girl standing right next to me, "So you saying she was drunk?" And I'm like, no, 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 I'm not saying, I don't know that. I'm just saying. But the girl was so aloof, she didn't even catch the fact of what the 911 operator said. So anyway, she was careless, indifference to loss. Really, what morale stands for is the fact that someone has insurance and they're like, yeah, I'm going to be more reckless in my life because I have insurance. That's a morale hazard to an insurance company. So that's that stuff. Then you have insurable interest. This is really important in life insurance. An insurable interest question is probably going to show up on 95% of all insurance exams. It's a financial interest in the continued life of the insured, must exist at the time of policy application, and it prevents wagering on someone's life. So at the time of application or at the time of the policy inception, there has to be an insurable interest, a spouse, a family member, a child, a business partner, somebody that if their death occurs, it's going to financially impact your life. And I've got I have a crude example for just about everything. But my crude example of an insurable interest is if, let's say, you meet someone in a bar, you see them across the bar, and you have an instant connection, and you're like, oh, that person is amazing, I want to meet them. And you go and you meet them, and they do happen to be single, which that's helpful. And you have a date, and the date goes super well. And then you tell all your friends, like, oh, I had this date, this person is amazing, and I think I'm going to marry them. And then you come on the second date, and you bring an insurance policy on the second date, and you want them to sign a life insurance policy. That's not insurable interest. It's not going to cut it. And also, you're probably not going to have a third date with that person because they're going to be incredibly creeped out. But that's not insurable interest. Um, and then as far as wagering on someone's life, you can't just find a rich guy and get insurance on them so that you can draw insurance on their life just because they're rich. Doesn't work that way. Lapse. A lapse is the termination of a policy due to non-payment of premiums. Usually the grace period on payments for a life insurance policy is 30 to 31 days. Some states have a very specific guideline for this. Again, in the state of New Jersey, who I've been working with Travis on, his state is 31 days across the board. So every 31 days is the grace period for payment. So it doesn't matter how many days are in the month, it's 31 days. Surrender. You can voluntarily terminate a policy and walk away with the cash value. Only on a whole life policy, which is also known as a permanent life policy, but you lose the death benefit protection. Okay. And then the contestable period. That's the first 2 years when an insurer can investigate and deny claims for material misrepresentation. A material misrepresentation basically means a lie or a misstatement. It could just be a misstatement. It doesn't necessarily have to be an overt lie. And I see some other returning folks in here. Natasha, welcome back. Let's see who else. Walisha, I haven't seen that name before. You might be new. Welcome. If I don't say your name, don't get mad at me. Everybody else I think was already on here, but welcome. All right. So contestable period. First 2 years when an insurer can investigate and deny claims. Like I said, material misrepresentation. Could be a lie, could be just you didn't know. Again, maybe you went to the doctor for something and you never got your diagnosis, so you didn't know. The doctor knew, may have even got reported to the Medical Information Bureau or something like that, but you didn't know. So when they asked you, do you have diabetes? You say, no, I don't have diabetes. And then maybe even later on, after you get the policy, you find out that you do. And then he didn't, maybe you even find out that you had it at the time when you got the life insurance policy. Well, you still could be in trouble. You still could get your claim denied if your death results in from diabetes within the first 2 years and they investigate and find out, in fact, you did have it before you got the policy. They could deny that claim. So, of course, you're going to be gone. It's not going to matter, but your family, they're going to be the ones that get screwed. But after 2 years, a policy becomes incontestable, meaning they can't deny the claims unless they can prove that some sort of overt fraud happened in order for the person to get the policy. And a lie is not overt fraud. A misrepresentation is not overt fraud, because that's really hard to prove. But if someone manufactured a birth certificate or something like that, they came up with a fake ID somehow, that would be overt fraud. That's the main one I can think of. I don't really know what else fraudulent or some sort of maybe a made up medical record or something like that. But after 2 years, unless something like that happens, they can't really contest the death benefit. It's going to pay out. We're not going to cover all this stuff, so I'm just going to move on. I'm going to, in this short session, I'm going to quickly cover ordinary whole life, and I'm going to cover these because I think these are really tough for people, and then I'm going to cover term life, and then I'm going to switch over to my other thing that has some health slides. So we're going to cover a few general health topics, and then at 10 o'clock for our last hour, we're going to do some live testing, which is going to be questions that are most like what you will see on your actual exam. Actually, I'm going to get those queued up now. Where's that at? That's not it. That's okay. I can actually, nope, that's New Jersey. Don't want to use that. I'm going to get this queued up. Hold on just a second. Favorite bookmarks. Oh, no. Sorry. Bear with me. Here we go. I don't want that either. This is the one I want. All right, cool. That's what I want. That's what we're going to go to when we get done. So, all right. Ordinary whole life. So I'm going to draw this real fast. So ordinary whole life, you have a $100,000 death benefit. And then you have, let's say, $100 a month premium. It's just for an example purposes. That's all. This is the premium. And then the difference in a whole life and a term life is this has a cash value. So possibly $80 of this $100 is going to build the cash value. And then $20 is going to pay for the death benefit. Again, it's just an example. Don't hold me to it. It just is what it is. So over time, This $80 builds this cash value. So these have level premiums throughout life. They have guaranteed cash value accumulation. The cash value gets deposited in the insurance company's general account, and it grows over time. So there's no investment, anything like that. We'll look at those on the next page. And then they have a fixed death benefit. So this doesn't change. Although the beneficiary, depending on how the policy's set up, they could receive the death benefit and any unused cash value. That could be possible. So again, if it's set up that way, and this policy was in force for 15 or 20 years, and it has $20,000 in cash value, then the death benefit upon the death of the insured would be $120,000, because it would be $100,000 plus any unused cash value. Then another couple of examples of whole life are limited pay. The premiums are paid over a specific period, such as 20 pay life. The way this would work is on a $100,000 policy. Again, it's just an example. The premiums might be $1,500 a year for 20 years. And so part of this $1,500 would go towards building the cash value. And then once the 20th payment is made, then this death benefit goes into the lockbox, I call it. It is, you own it now. That's an owned death benefit. It's paid up. No more payments. So you'll have that, then you'll have cash value. The cash value builds quicker because you're funding it quicker. So if you're funding $1,500 on the first part of the year, your cash value is going to grow much quicker because more money is getting funneled into the account quicker. And then that it goes into the general account of the insurance company, and it starts growing right away. Instead of being $100, $100, $100, $100, it grows over time. You're growing it quicker because there's also a single premium. So in a single premium, it's one lump sum payment. So you might have $100,000. Now, again, this might be extreme. I don't know. A single premium, one lump sum payment. The premium might be $30,000 to pay for this $100,000 policy. So 20,000 of the 30 might be cash value. So you already have cash value right away on a single premium. And then same as the 20 pay, but it's right away. You own this death benefit. And Asia asked a question. Yes, it does. A single premium whole life policy automatically becomes a MEC, which is also known as a modified endowment contract. So what is the issue with a MEC? Well, the other thing you need to know about a MEC is it fails the 7-pay test. I'm not going to explain what that is. It's too short of a session, but that's what's asked on an exam. In fact, what I'm going to do here, because it's a good question, since it's right here, is I'm going to fast forward to my information on MECs really fast. And go over those real fast because it's a tricky thing for people. A lot of people struggle with MECs. It's in here somewhere. I know it's in here somewhere. Hold on. There we go. Modified endowment contracts. So fails the 7-pay test. Basically, it means it's too much premium too soon. But why is it important? Because it loses its favorable tax treatment. So I was actually just going over MECs with Travis, and I have always known the right answer to this question. I just didn't know what it meant. Now, you could have 1, 2, 3, probably 3 would be about the max questions on MECs on your exam, a life exam, not health. This is just life. But what happens is The reason why a single premium whole life policy automatically becomes a MEC is to prevent money laundering. Scott, yes. Yeah, that's the main thing. It's to prevent money laundering, because other than that, the only it would be you would be penalizing you'd be penalizing good people, I guess, if it wasn't basically for money laundering, because effectively what it does is uh modified endowment or whole life policies, annuities that you pay over time. They have tax benefits for those being paid out over time. It defers the taxes on them. But if someone basically overfunds a um, a whole life policy, and specifically, and then they turn around and they try to take a loan out so that they're getting a check from a an insurance company. So Scott, the other way would be just be like rich people trying to sidestep the tax code, basically, by saying, all right, I'm going to take my, I've got all this money and I'm going to put it into uh, you know, a whole life policy so I can immediately take a loan out on it and then I won't have to pay taxes on it. Well, that doesn't work because it's a MEC. So it may not just be money laundering. It just may be, wealthy people trying to sidestep the tax code. So, but how this works, and again, I knew the right answers. I just didn't fully understand it. So let's say you have someone that they do a MEC and they end up with $40,000 in cash value right now. Well, if they try to take out a loan of $40,000, see, loans are generally not taxed. If you don't have a MEC and you have a whole life policy and you've been paying on it for 20 years and you take out a loan, it's not going to be a problem. You're not going to pay taxes on it. But if you do it as a MEC, then they treat this 40,000 and they make you pay taxes on it. So it basically takes out all the teeth. So there's no advantage to someone trying to launder money this way. Because if you know anything about income taxes, whenever, like, if you say get like a large bonus, or if you're commissioned and you get a large commission check, the way taxes work is they look at that as if that's what you make all the time. So they hit you with the worst tax burden they can. All right, Juan, no problem. And I appreciate the kind words. I'm happy to do it. I'm happy to do it. I don't know why he called me Adam, but my name is Matt, not Adam. I did forget to change my thing. So again, thank you for letting me know. I forgot to change my do. Change. My name's Matt. I also go by Joel. I'm just kidding. I don't ever do that. I tried to do that. I went to a new school when I was in ninth grade, and my middle name is Joel. And I tried to go by Joel for a whole year, and then they discovered that I normally go by Matt, and I got made fun of horribly by the seniors of that school. They actually wrote a poem about me, and they read it at graduation called "Ode to Joel." Juan, did you put your email address down anywhere? If I have your email address, I'll send you over study materials. So just make sure I have. You can put it in the chat or in the Q&A. I don't care. I like to keep it in the Q&A if at all possible because it's easier for me. But yeah, I got you now. I can get it from there. That's no problem. It's short sessions are not bad, but the long sessions end up getting buried way high in the chat, and it bothers me. So it wastes my time. By that time, I'm ready to go to bed. All right. So again, MEC loses its favorable tax treatment, and then on top of that, if the person that's trying to do it is under the age of 59 and a half, on top of getting taxed heavily, then it also loses its favorable tax treatment. So it's like a double whammy, kind of. So, but that's good. MECs is a great thing to cover because, again, it's an area that people highly struggle with. So I am actually going to real fast. Hold on. While I have you guys here, I'm going to go ahead and snag your email addresses. So I really don't want to go back later on. So I'm going to go ahead and snag these real fast. So bear with me. If you're watching on YouTube, this is riveting. And by providing this to me, you inadvertently are putting your email out that could end up on YouTube. So sorry about that. There we go. But I want to make sure you guys all get your study materials. And I have had some internet issues recently, but I haven't had any too recently. All right, got yours too there. If you guys put it in the Q&A, I won't have to do this. So Q&A is along the bottom. It might be under the more 3 little dots, because it's real quick for me to grab things out of the Q&A as opposed to the chat, because then I have to, because when we do live testing, you guys are going to put in your answers in the chat, and then it just buries it and buries it and buries it, and I don't want to go back through. All righty. What am I going to do now? I think what I'm going to do, I'm going to switch over to this real fast, and I'm going to skip. All right. So this is going to be more for our life and health people or our health only people. Let me check my poll here real quick. Oh, it doesn't say we have any health only people here, but we do have half life and health combined, and then some life only people. Don't worry, life only people. We'll get back to you shortly. But I don't want to leave the health people out in the weeds completely. So we're going to cover some health topics. And one of the areas that a lot of people that are doing health struggle is the social insurance. That's one of the areas that people struggle heavily with. And like I said, the question was asked, is health more difficult than life? No, I wouldn't say that. I wouldn't say it was more difficult. I would just say that it's, with life specifically, it's more conceptual, meaning knowing the why behind the what can help you get to the right answer. But with health, it's just term driven. So, there's not a whole lot of extra I can give you as far as tips to help you learn it. You just got to learn it. It's more like a big vocabulary test. So we'll cover it. You can take notes on it. Hearing it might help you reinforce it. But again, I'll be expanding some things to help, but health insurance is just very direct. So social insurance, those are programs like Medicare, Medicaid, and Social Security for you life and health people. They are heavily tested. Now, as a life person, if you're just doing life only, it is very helpful to know these things, because honestly, it's something you're all going to deal with eventually in your life. And then you also might have family members that are dealing with it right now. So you can help people with this. So Medicaid, Medicare, know the differences, eligibility requirements, and coverage details. So those are the things that are going to be tested on. What's different about Medicare? What's different about Medicaid? What are the different Medicares? Eligibility requirements and coverage details. Social insurance refers to government-sponsored insurance programs designed to provide an economic security and healthcare coverage to eligible individuals. These programs are funded through taxes and provide a safety net for retirement, disability, healthcare, and low-income assistance. Now, Medicare is federal health insurance. All right. So it's designed for people age 65, or if you become disabled and you're not 65 yet and you've been disabled for 2+ years, then you are eligible for Medicare after 2 years. Bear with me. I'm going to grab a drink real fast. What drink we grab? Okay. Tonight's live session is brought to you by Canada Dry Cranberry Ginger Ale. Very festive for the holidays. And it doesn't have caffeine, so it won't keep me up all night. The other thing about Medicare is if you have ESRD. My wife has a cousin right now that is actually going into hospice tomorrow. She has ESRD, which is end stage renal disease, also known as kidney failure. So she gets dialysis regularly, and they are taking her off dialysis and everything she's on starting tomorrow morning. And then she will be in hospice care probably for the next week or so. But that's what ESRD is, end stage. So if you have that, you automatically qualify for Medicare coverage. Medicaid, state, federal health insurance for low income individuals. So just remember, Medicare is age driven or disability driven. Medicaid is aid for low income individuals, and it is administered by the state. Medicaid is probably the best example of health insurance for the country. You know, the overarching social idea is that it should be Medicare for all. Heck no. That would be terrible. If anybody ever figured out how to communicate this to the country, Medicaid for all, then, you know, I could probably get on board with that if it was handled the right way, because it's the perfect marriage of government and the private sector, because the private sector administers it. It's done by private insurance companies, and the government funnels taxpayer money into it, and it works fantastic. Medicare is mid at best, if not a disaster. I love Medicaid, and again, we'll learn more about that. Well, probably not tonight. Social Security is retirement, disability, and survivor benefits. It's SSI income. Here's just a little fun fact about insurance. You might want to bar bet with this or something. The word insurance comes from the Latin word securus, meaning free from care. If you have insurance, you're free from care, right? The modern insurance industry as we know it began in 17th century London at Lloyd's Coffee House, where ship owners would meet to discuss sharing the risk of maritime voyages. So transatlantic voyages, moving their goods from, you know, Europe to the New World oftentimes, or other areas of Europe. That's what they did, is they got other people to back their loads. So they would pay money to people, say, hey, if something happens and my shipwrecks, will you cover my load? So that was a way to make money, and that's where insurance was born. All right, Medicare Part A, also known as hospital insurance. And that will help you, knowing that Part A is hospital insurance, knowing how to answer the questions, basically. For eligibility, it's age 65 plus. If you have worked 40 quarters, there are 4 quarters in a year. There's one of your math questions. 40 quarters equals 10 years. So if you've worked 10 years, then when you turn 65, you will be eligible for Medicare. It's closer for me than I ever imagined I would get. Um, but if you are under 65 and you have a disability, you can get it after you've been disabled for 24 months, as I already said, or ESRD, end stage renal disease. There's no premiums usually on Medicare Part A as long as you have proper work history. If you don't, then there might be premiums. Don't know of a situation that has that, but there might be. If you are already receiving Social Security benefits by the age of 65, you will be automatically enrolled in Medicare Part A. If you know somebody who isn't receiving Social Security benefits and they're hitting 65, you need to encourage them to do the following things. Enroll in Medicare Part A. Immediately enroll in Medicare Part B, even though it has premiums. Go ahead and do it. And then go find a Medicare Advantage plan or a Medicare Part C plan. And that is the ultimate goal. That's where you want to be. And I'll explain all the reasons why here in the next couple slides. Medicare Part A covers inpatient hospital care. You get semi-private rooms. You might have a roommate. Meals, nursing services. You're going to be taken care of in the hospital if you have Medicare Part A. Skilled nursing facility care. So you could, it's usually after a 3 or 4 day hospital stay, you can get up to 100 days in a skilled nursing facility with conditions. Hospice care for terminally ill patients. Hospice care. Hospice care is end of life care. It's covered under Medicare Part A. Home health care, limited, part-time, skilled care. You're probably not going to get an RN at your house with Medicare Part A, but you're probably going to get an LPN or something like that. Inpatient care in religious non-medical healthcare institution. You're not going to see this question, so I'm not going to belabor the point, but there are certain localities that have religious non-medical places. In our area, it's called Otterbein. You guys might have a specific one. Otterbein is Methodist, and Medicare Part A will cover someone going to live in a religious non-medical healthcare institution. You don't need 24-hour healthcare coverage. It's just minor assisted living. Now, here's a big Medicare Part A question right here. This will be on 100% of all health tests. Health only, especially, but life and health most likely. 95 to 100%, okay? Because Part A has a deductible period that's called per benefit period. It is not per year. This is how it works. I'm not even reading it. This is off the top of my head. This is how many times I've taught this crap. So when you are admitted into the hospital, and say you get admitted, so you're there, for ease sake here, we're going to say 30 days. Okay. So if you were in the hospital for 30 days, then you get discharged, and then you are out for 60 days continuously. I mean, you don't go back. You're out for 60 days. That's your benefit period. 90 days. That has to do with the deductible, whatever the deductible is. Now, is it beneficial or is it non-beneficial? I don't know. It is what it is. That's your deductible period. So most places have a deductible that's based on the entire year. I would say it would be less than beneficial, honestly, because it starts over every time you have this situation. But I guess because it's hospital insurance, you could potentially go throughout the whole year and not use any of your deductible because you never got admitted to the hospital. But Medicare Part A, if that's all you have is insurance, you're not fully covered. It's only basically catastrophic care where you end up in the hospital. But we move on to Medicare Part B, which is more traditional insurance. Medicare Part A and Part B go hand in hand. Medicare Part B does not supersede or replace Medicare Part A. And again, it's more traditional medical insurance, whereas Part A is hospital insurance, Part B is more medical insurance, and it is optional. You can adopt it. Like I said, I encourage everyone that gets Part A to adopt Part B. It does require a monthly premium, although it's nominal. It's not a huge monthly premium. There are penalties for enrolling late. And we'll look at that right here. So it's voluntary. You got to volunteer for Medicare Part B. There are enrollment periods. There's initial enrollment period, 65, general enrollment periods, and special enrollment periods. There's some different enrollment periods if you have like extended coverage through your employer and you're still employed. You can wait on Medicare Part B for a certain amount of time without penalty. But late enrollment is 10% premium increase for each 12-month period delayed. Oh, it sounds terrible, right? That's not really that bad. Again, if you wait a year and your premium is supposed to be $20, it's going to be $22. So it's not going to, some people $2, especially if you're on a fixed income, might be huge. So don't wait. Annual deductible, as opposed to Medicare Part B or Medicare Part A that has a benefit period deductible, Medicare Part B has an annual deductible. So before coverage begins, you must meet the deductible. It is just like general insurance. Medicare Part B is typically 80-20, meaning the patient pays 20%, the insurance pays 80%. And what does Part B cover? Different from Part A. Physician services and outpatient care. You can go to the doctor. With Medicare Part A, it's not going to cover your doctor visits. That's only if you're in the hospital. Preventive services, screenings, vaccines, annual wellness visits. It's going to operate more like general, insurance. What's up, Bug? What do you need? Oh, you need batteries. Okay. I'm sorry, my son. I don't know if I have double A's. Move. I gotta get my battery, buddy. Bear with me, folks. Hold on. Oh, I do. Hey, look, you're on the screen. Say hi.
Hi.
You see. Do I need a dumb screwdriver?
Screwdriver?
God bless it. It's one of those ones that doesn't have a little screwdriver. Please hold. I'll be right back. I don't take any breaks in a 3-hour. Oh, that's cool. That's very cool. Hold on. Don't leave it on all the time. I'll show you what I was doing here. It's a Coke sign. I don't know if you can see it. It's so bright. It's all lit up. It's a Diet Coke sign. My son's favorite drink is Diet Coke. So for Christmas, someone got him a really cool light up Diet Coke sign. So let's see. Which actually we'll talk a little bit about my son. He has learning disabilities. So he actually has Medicare and Medicaid. He has all of it. He has everything he can get. Let's see. Preventative care, we said medically necessary services and supplies, outpatient care, physical, occupational, and speech therapy, durable medical equipment. So if you need a wheelchair, walkers, or hospital bed, you're going to get that through Medicare Part B. Mental health services on an outpatient basis you get with Medicare Part B. And then limited outpatient prescription drugs. So any drug that you can get at the hospital or at the doctor, Medicare Part B is going to cover it. But if it has to go out to a pharmacy, then they're not going to cover it. You have to have Medicare Part D, which equals drug coverage. D equals drug coverage. We'll cover that in just a minute. A little fun fact again, Medicare was signed into law by President Lyndon B. Johnson on July 30th, 1965. Former President Harry Truman and his wife Bess were the first Medicare beneficiaries, receiving the very first Medicare cards at the signing ceremony. So there you go. A little fun fact there. All right, Medicare Part C. All right, as far as Medicare goes, this is the bomb diggity. Medicare Part C. It's called Medicare Advantage plans. So Medicare Advantage is offered by private insurance companies. It replaces original Medicare, Part A and Part B. It does not supplement it. So in order to get a Medicare Advantage plan, you have to be enrolled in Part A. You have to request Part B. Gretchen says, thank you so much for this prep session. I have to leave for now, but I look forward to reviewing the replay. Have a good night. Thanks for hanging out, Gretchen. Have a longer session tomorrow if you want to return. If I have your email address, I will. It has my schedule of my live sessions and a link to my live sessions in that particular email as well. So thanks for hanging out, though. Appreciate you. All right, Medicare Part C. Again, Medicare Advantage. We have had a Medicare Advantage agent that's been in here. He hasn't been in a while. I think he already maybe took his exam, but he was health licensed and he was taking his life exam. So haven't heard from him in a while, but he would keep me straight on my Medicare Part C facts. He never scolded me, so I guess I'm teaching this correctly. I've never been a Medicare Advantage agent, but a lot of people that are getting their health license, this is what they end up doing as Medicare Advantage plans, which, hey, great. You will be dealing with older population, so if you're geared towards that, then that would be a good thing for you to do. There is pretty steady money in it. It's obviously hotter at a certain time of year during open enrollment, but there's always work for Medicare Advantage plans. So you must have A and B to enroll. The Medicare Advantage plan provides the coverage. They're done by private companies. They're regional. So like in my area, it's covered by, I believe, United Healthcare and Aetna. They already have Part D involved. So they have prescription coverage within the policies. A lot of times also they have vision coverage, dental, hearing, and then also sometimes they have a fitness program. My mom had a Medicare Advantage plan. She could have got a gym membership. She never did, but she could have. These have network restrictions. They're usually ran by an HMO or a PPO, and they have provider networks. So I'm going to explain HMO and PPO to you real quickly, like an overview. So HMO, again, I think this is like really good life knowledge, like what an HMO and a PPO does. So the long and the short, the basics of an HMO is you have to use network providers. So you are stuck in the network. HMO stands for Health Maintenance Organization, and they rely heavily on preventative care. So like vaccines and regular checkups and things of that nature. HMOs are very in tune with that. They require PCP, not the drug. They require you to have a primary care physician. So you got to have a doctor, a home doctor that you call your home doctor. And if you need to go to a specialist, or if you want to go to a specialist for something, that primary care physician has to give you a referral. So basically they call the primary care physician in an HMO, they call them a gatekeeper. I call them a puppet master. There's like marionette puppets where they have strings attached to them. That is your primary care physician. They're managing your health care. A PPO, though, which is called a preferred provider organization, they do not require you to have a primary care physician. If you want to go to a specialist, you can go directly to the specialist. I use the example, I have a PPO, and I had a foot and ankle problem and there is a foot and ankle doctor literally seemingly like in my backyard. It's very, very close to my house. And I went directly to them and got checked out, and my insurance covered it. So I use preferred, like I said, there's not a whole lot of tips, but if you want to go outside of your network, you can do that in a preferred provider plan, because that is what you're allowed to do. HMO, if you go outside the network, you have no coverage. If you have a PPO, you can go outside your network. You're just going to pay a little bit more for it. And also the reason why, like an HMO, um, basically requires you to use a network is because they can fully control the cost of their providers. And the reason the PPO charges more if you go out the network is because they have less control over the providers that are outside of the network. They still have a network, but you can go outside of it and still get coverage. That's the basics. There's a few more caveats to HMO and PPO, but that knowledge I just gave you is going to get you most of the way on your testing. And then private fee for service plans, it's basically a combination of an HMO and a PPO. You can you do have to have a primary care physician with a PFFS plan, but you don't have to have referrals for specialists. So you have a little bit more leeway with those plans. Again, because the plan, Ossia says, so PPO is more for convenience of the policyholders. HMO is less risk on the insurer since they manage every specialist. Yeah, that's a good way to look at it. The one thing, again, about HMO plans, again, from a selling standpoint, is they're a little bit cheaper than PPO plans. Again, PPO, you're going to pay more for it, but you're paying for more control. So you have more control as the policy holder. I don't know if HMO is necessarily less risk on the insurer. Maybe a little. Do you have a PCP with Medicare Part B? I was like, Scott, that's a good question. It's not really a testable question, but you could. So Medicare Part B often acts like either an HMO or a PPO. It really just depends on the plan. So it may or may not, but as far as that goes, I wouldn't really worry about it. And the same with Medicare Part C. So with Medicare Part C, it acts like a HMO or a PPO. So how it operates depends on who's managing the plan. So, but yeah, I wouldn't worry about that for testing purposes. You're not going to have a question that covers that, because that's more for like down the road if you are like happen to be an agent and you're selling like Medicare Part C or something like that, or you even could work for the government, work for Medicare. That'll be more of a detail that you would deal with there. But for testing purposes, it's not that important. And then for Medicare Advantage, there's also SNP, or their special needs plans for specific populations. Probably not going to see that on a question either. I've never seen SNP plans on that before. But here's something that's a little bit important for the exam. To enroll in Medicare Advantage, you must have Part A and B already to sign up for Part C, which if you have both A and B, 1000% sign up for Medicare Part C, because oftentimes they don't even have a premium. They're getting guaranteed money from the government anyway, so they make them premium free to offer that as an extra benefit, to make them more competitive against other private companies. And that's why I think they're amazing, because it's a kind of a perfect marriage between private and public. So I like Medicare Part C, although I've never been an agent, but I would. I would do it because I get along with old people pretty good because I kind of am one. And that's basically who you're talking to all day. And you're basically selling something that's free that has all kinds of different advantages. And if it's free, it's for me. So I'm good with that. But they also, remember, have service areas. They're generally driven by states that are contiguous. They're joined. Like I live in an area where Indiana, Ohio, Kentucky, West Virginia, we all touch. So, a Medicare Part C insurer might cover all those states. And then, like Michigan, also, we're all Pennsylvania, we're all touching here in Ohio. So, that they would probably all be in that service area. Some are just like East Coast, whatever, it doesn't matter. But you have to live in the planned service area in order to enroll in it. So it would be whatever particular company. And then also, you cannot have end stage renal disease. And then it says with exceptions. I don't know what those exceptions would be, but you can't have ESRD with Medicare Part C. You're basically limited to Medicare Part A with ESRD because you're at end stage renal disease, meaning you have a very short ticking time clock and you're probably going to be spending most of your time just in the hospital. So all your needs are going to be met that way. So Medicare Part D, this will be, it may not be the last thing we cover, but Medicare Part D is voluntary. You can either add it to Part A or B, or it's pretty much automatically included with Part C. Again, with a lot of Medicares, it's offered by private insurance companies. So if you have Part A and you opt for Part D, so you can have some drug coverage, it's going to be managed by a private insurance company. So they're going to send you a separate card for your drug coverage. And again, I think that's, monotonous. Might as well go ahead and do Part C. That way you already have it. The premium would vary by the plan. And then it's tiered. So it's called formulary. This is a question that could end up on the exam. That's the way they do it. So you choose which plan has the covered drugs that you need. It's tiered. That's how that's what it is. It's formulary. Each plan has a list of covered drugs. It's tiered. Late enrollment penalty for Part D. So whenever you enroll in Medicare, if you wait to enroll in Part D, they will penalize you 1% of the base premium times the months you go without coverage. So they want you to have drug coverage effectively. They want you to be able to get access to the medicine that you need to stay healthy. The deductible, you pay the full cost until the deductible is met. You have co-insurance. Basically, the card will say how much that you have to pay in order to just like with every insurance, you get your card that says a doctor visit costs X amount of dollars and your drugs are $15 or $20. That's how Medicare Part D works. And then this is shrinking. Okay. So there's basically a coverage gap in Medicare Part C, which is known as the donut hole. This question generally does get asked still on exams, but basically it's higher cost sharing until the out-of-pocket limit is reached. So this is closing. The question that will often show up on the exam is what's happening to the donut hole or the coverage gap. It's closing. I think it's down to like 25% or something like that. But eventually this is going to be gone if it's not already gone. But the donut hole is closing. But basically it's the coverage gap in Medicare Part D, and it doesn't get too deep in the questions. And then also Medicare Part D has catastrophic coverage. You pay small copays or coinsurance after the out-of-pocket max. So, if you need major drugs, expensive drugs, cancer drugs, and stuff like that, you've already met your deductible, then you're under catastrophic coverage and you'll just pay a small copay to maintain those drugs. So here's exam alert creditable coverage. If you have drug coverage from another source, employer, union, VA, that's at least as good or as Part D, you can delay enrollment without penalty. Oftentimes, with social insurance, if you have employer coverage or if you already have drug coverage, then you can wait to enroll in Medicare Part D. You just have to prove that you already had coverage and then prove when that ends. Then you can enroll in Part D without penalty. So, and then also keep in mind, if you're enrolling in like Medicare Part C doesn't really acknowledge those penalties. They do what they want. So they're not going to pass those penalties on to you. So here we just talked about this. The infamous Medicare Part D donut hole is being gradually closed thanks to the Affordable Care Act. By recent years, beneficiaries in the coverage gap pay significantly less than Part D was introduced in 2006. The donut hole has officially closed in 2020, meaning beneficiaries now only pay 25% during the gap phase. So the donut hole has closed. All right, so we'll do this slide here for Medicaid, and then we will jump into some live testing. And the live testing is questions that you are likely to see on exam day. Oh, I see. Yeah, I got that. I'll copy it straight out of here, so I'll get the 0. Rachel, thanks for hanging out. ESRD is end-stage renal disease. Basically, it's kidney failure. So that's what that's referring to. And then Nathaniel's getting ready for his exam next month. Most questions are starting to make sense. That's awesome. That is awesome. So glad it's coming together for you. And it's a good feeling when it all starts to make sense. You know, it's tough in the beginning. Yeah, studying absolutely counts. These live sessions, I haven't said this tonight, and I haven't said it very often, but I had a young man in one of my earlier sessions. I always remember him. His name was Lincoln, and he asked me, he says, if you only join the live sessions, what can you expect to score on the exam? And my answer was a 1%. I will get you a 1%. That's all I'm going to guarantee you. I think I can get one. You know, and even that guarantee is pretty hollow because I don't know how well you guys are listening. I don't know how well you guys are interacting. I don't know what you're doing on your own. I really don't know. But again, if you are going through the modules, you're pacing yourself, you're not rushing through them. And then, you know, once you finish the base content, you're doing study or your practice exams using some flashcards, study videos, whatever it is that you're doing on test day, you know, you're going to be in pretty good shape. So, and then again, use me as a what's the word? Utility? Well, I don't know. Resource. That's a better word. Resource. And, you know, I will always try to help as much as I possibly can. And, you know, I've done one-on-one sessions with people, dragging and kicking and screaming over the finish line, but we'll get you there. We'll get you there. All right, Medicaid. All right, so the main thing about Medicaid is that it's based on income. So local, state, joint, federal, state program funded by both. So the state kicks in money, the federal government kicks in money. Again, that's why I think that it's really good program because individual states know their constituents, whether you want to admit this or not, but people are different in every state. People are wired differently, and usually the state governments reflect basically the sentiment and values of their constituents. So something like Medicaid that is geared towards the people in the state, it just makes sense. So it's income based. No premiums or deductibles generally. There's minimal or no cost sharing at all. So again, we're wondering how in the world we can achieve this. This is the way to achieve it. State variation. Each state determines eligibility, benefits, and provider payments. There are mandatory versus optional benefits. States must provide mandatory benefits, can add optional ones. These are usually administered by private companies, and they can be competitive. You can choose different companies a lot of times. So they can have different, benefits. And again, it's being funded by the government. So they can be some pretty amazing coverage. Low income families with children are eligible groups. Pregnant women, CHIP, Children's Health Insurance Program. That would be children that maybe are orphans, maybe they're in the system, like the foster system. They can get access to Medicaid. Elderly individuals can have both Medicare and Medicaid. That would mean basically they are elderly and they have lower income. People with disabilities can qualify for Medicaid. Recipients of supplemental Social Security income. So if you have SSI, you could potentially be eligible for Medicaid. It really just depends on how much you get. My mom never worked a day in her life outside of the home, but she drew SSI from her first husband, and she made too much money through SSI and a small pension to draw Medicaid. So it just really depends. But Medicaid coverage covers inpatient and outpatient hospital services, physician services, laboratory, x-ray, nursing facility, home health care, preventative care, family planning, and more. Long-term care is a major benefit not typically covered by Medicare. So one thing that happens when someone exhausts the long-term care coverage in Medicare, meaning that's a maximum of about 100 days, then if they have to be in there longer, then Medicaid kicks in and they start taking their income. They start making them draw down their money, their assets, sell their properties potentially. That's the things that Medicaid does. So Medicaid is the primary payer for long-term care or nursing homes in the United States, and that is highly tested on. That will show up on a lot. If you're doing life and health, you'll see that question often on there. All right, so it is 10 o'clock. We have about 1 hour left in this session, roughly. So I'm going to go over to a live test here. Where did I already had that pulled up. Here we go. So these are questions that you are likely to see on test day, worded the same way, structured. They're not exact, but they're close. You guys can use the chat and you can answer. I know it doesn't have A, B, C, or D, but that's what it is, A, B, C, or D. You can use that. You again, or you can just follow along. I'm going to read everything, and then I'm going to read the explanation that pops out when I answer. So this is life, but it'll go back and forth. Life and health. In cross-purchase buy-sell agreements funded with life insurance, which statement is correct? A trust owns the policies on all owners. Each owner owns policies on the other owners. The business owns the policies on each owner, or no life insurance is used in cross-purchase agreement. Asia has come in with an answer. I don't see anybody else answering, but if you want to copy off somebody's work, I would suggest copying off of, hopefully I'm pronouncing that right, Asia. Maybe it's like quicker. You can let me know if I'm close. Scott says B. I'll be the third B. Yes, that's correct. Or Morel, if that's easier. Oh, more. I said Morel. Is it moral or morel? Is it I think we covered this the other day and I already forgot. Now I remember you. And it's B. Yes, that's correct. So B, in cross purchase agreement, more like the sausages. Morel. Okay, morel. I don't mind saying either, to be honest with you. In a cross purchase agreement, each owner purchases policies on the other owners upon death. Surviving owners use the death proceeds to cover to purchase proceeds to purchase the deceased owner's interest from their estate. C applies to entity. Yeah, that's correct. So, yeah, that would be the business. That would be paying the business back on the death. But cross purchase, which is what we're talking about here, is the owners have it on each other. And these are survivorship life policies, which I did not cover tonight. I can actually go back and do that really quickly. It's actually, weirdly enough, it's one of my favorite things to teach. I don't know why. I think it's because I just know it for better. Keyword I think is cross, is in they yeah, cross. I usually do this, but I'm not coming out cross. I haven't seen this question on any of the pre-tests. Oh, okay. Sometimes it asks if they own it on themselves. Yeah, that would be. Once we pass the exam, will we be offered the life health insurer's job, selling things online, or what's the next step? Are you already with an agency, Nathaniel, or are you a free agent? What? Scott, there's no question. What are you answering, bro? Just throwing out a C. Not yet an agent. Oh, man, are you doing life and health? Yes, life and health. Well, man, the world will be your oyster. You can I'll tell you let me tell you what's gonna happen. There was a question on your screen for say. Oh, so sorry. Yeah, I'm trying to flip through here and go to teach some no, that's a good question. So usually folks that are here are already being sent by an agency. Um so I'm going to tell you what's going to happen though. So as soon as you get your license, you're going to be recruited by tons and tons of agencies. They're all going to reach out to you, and then you have to decide what you want to do. So if you have life and health, again, you can do Medicare Advantage plans. You can do, you could go be a captive agent for one company, like we have had in my sessions. I said the guy that sold, I think his name was Eric, sold Medicare Part C. My best friend just texted or called me. He has radar for when I'm in live sessions. He always calls me when I'm in a live session. So yeah, you know, there's so many different things you can do. It really is what you're geared towards. If you want to show up, let's see, tomorrow the live session starts at 3. If you want to show up at 15 or 20 minutes early, we can kind of talk about that a little bit. And I can you can just kind of ask or kind of tell me what you're interested in. But you got all kinds of stuff. There's definitely a lot of different things you can use it for, a lot of different avenues you can go. So it depends. Again, usually people here are already with an agency, so they know what they're doing, or somebody else is going to tell them what they're doing. You're going to be in a different situation. You're going to be able to choose for yourself. So, all right. So I wanted to go over this really fast, which kind of covers the. It was in the case of ambiguity. Does it a favor of the insurer? Oh, it was. A contract of adhesion is what you're talking about, Scott. Yeah. Yeah, I was coming over here to explain joint life and survivorship life real fast. Actually, I was really just going to cover joint life because we were talking about buy-sell agreements because that's what most of these are. So when it comes to buy-sell agreements, I'm gonna draw a third person here. So these are joint life, which is first to die insurance, blanket policy. Yeah, as long as I have your email address, I will send you the link, and we will see you tomorrow. No problem. No problem. All right. So covers two or more lives. Joint life are generally um, uh, these are used mostly for buy-sell agreements or what's called cross-purchase insurance. Buy-sell agreements are cross purchase. Um, these pay upon the death of the first. So let's say all these guys, they're part owners in the Acme Dynamite factory. Okay. Now, just know when you have like an umbrella policy over multiple lives, that is cheaper than having separate policies. Okay. That's if they ever ask that question in any way, shape, or form where you have multiple policies under one policy, they're going to be cheaper. These are common for business partners, these joint life policies, because here's what happens. Okay. So, again, this is for cross purchase or buy sell agreements. Let's say this business owner tragically passes away. The death benefit goes to the other owners for the purpose of paying the family of this business owner so that they can fully retain ownership of the company. That's what they're for. Cross purchase, also known as a buy sell agreement. So the agreement is made, and then this is what happens. So then when these two guys are left, if they're the two remaining business owners, then they would have to redo another joint life or first to die policy on one another. Now, if it was only them two, then that would be it. But it's for the purpose of buying out the family of the other business partners so that they can retain full ownership of the business. All right, survivorship life. We'll cover it really quick, and then we'll get back into the live exam questions. But survivorship life covers two lives, and usually spouses, and it pays upon the death of the second insured. So, real quickly here. So these are husband and wife. This is their kid. Usually I give them a name, Spoiled Rotten Brat or Perfect Angel. We'll do Perfect Angel tonight. We'll give him a halo. And then this pays not upon the death of the first, but upon the death of the second. And hold on just 1 second. All right, sorry. My wife needed tools. And Allen wrenches are tough commodity to come by in this family. So, anyway, so here's how survivorship life works. So you have husband and wife, they've been amassing a assets over time. So we got a house. House has multiple car garage, really funky looking garages there. And they have cars. Probably not just one car. They probably got a whole bunch of cars. That's a snazzy sports car right there. Just use your imagination. And then usually they have another house, like say a vacation home, and it's on the beach, it's on the water. But what's attached to all this is debt. It's debt and it's taxes, right? So these guys, they've been working their whole life to amass all these assets. Usually, the thing about wealthy people is they might have more money than you or I do sitting in the bank, but they're not always liquid in their wealth. When someone says they're a millionaire, it doesn't mean they have $1 million sitting in the bank. Now they might, but usually it means they have assets. They may have stocks, they may have bonds, they have houses, they have cars, and they add all that into their value, their wealth. So when they die, when both of these die, survivorship life, survivorship, second to die, it pays upon the death of the second spouse. Now, it doesn't have to be at the same time. First one can die, and then 5 years later, the other one dies. That's when the money gets paid to the beneficiary when that happens. So, why is this important? What's it used for? Estate planning and tax purposes. Why? So, all this debt, all the taxes, the maintenance falls to the kid, right? So, if you don't have a survivorship plan, then what does he have to do? He has to sell the house, sell the vacation home, sell the cars. That's the for sale sign in the car window. But if he has a survivorship life, he can pay the debt, he can pay the taxes, and he can maintain the estate. He can keep it up. Then he has time to decide what to do, because if he has to sell everything, then he has to pay capital gains taxes on it because he's inheriting it. It's an inheritance. So he has to pay those capital gains. He could lose some of the property. Well, he'll obviously have to lose them if he sells them, and he can end up with hardly any money at all. Because death taxes on estates are wicked high. But if you have survivorship life to cover those things, they're covered. So you guys as an agent, again, if Nathaniel's looking for a job, go sell survivorship life policies. I don't know specifically how to do that, but general life insurance companies will sell survivorship life. And when you're dealing with clientele that are wealthy, the cost doesn't matter that much. Asia says, just to be sure, while joint life covers 2 or more lives, it's not the same as group life policy, correct? Yeah, those are individual policies that I just covered there. They're not group life. Group life are through employers. And let's see, 2 or more life. Yeah, it's not the same at all. There's nothing. You won't get joint life in a group policy. You won't get survivorship life in a group policy. Totally separate. Those are both personal policies. And then you said, since in group life, they don't have the same beneficiaries. They do. Yeah, in group life, you get to choose your beneficiaries the same as in personal life insurance, but that's more of for a specific purpose. So joint life is for a specific purpose, and then survivorship life is for a specific purpose, and those are both individual private policies, not under any group. Group's just not going to offer those because they're, more, you wouldn't have group life for joint life because those are more for businesses, so they would not be part of the group. And then survivorship life is for wealthy individuals that they would buy it on their own. So, but yeah, with group life, you can have the same type of beneficiaries as joint life. Well, not joint life really, because again, they're business owners. Yeah, sorry, that was a tough question because the way it was worded. But let's ignore joint life in that answer. Survivorship life wouldn't be covered. And Jesus is getting ahead of us. Split dollar life insurance arrangement offer involves which of the following? Premiums are split over multiple years. The death benefit is split between beneficiary, the insurer, the employer, and the employee share premium payments and policy benefits. Coverage is divided equally among 2 insured. I have one right answer and one wrong answer. I'm not going to say which. split dollar life insurance arrangement is C. A split dollar plan involves the employer and employee splitting premium costs and policy benefits, cash value, and or death benefit according to a written agreement. It's common in executive compensation. So split dollar plans are for your high dollar executives, your COO, your CEOs, things like that. When they're creating a comprehensive, competitive benefit plan, trying to basically woo or draw in certain talent, they'll offer a split dollar life insurance arrangement where they will split the cost, and they'll actually give them. That's where, as like an employee, if you get into the higher echelon, you can get a whole life policy or a permanent life policy, and the employer will pay for part of it, and then there'll be cash value involved in that and everything, and the business will like retain part of it for a while, and then they'll say, well, down the road, if you're with the company for 5 or 10 years, then we'll turn that whole policy over to you, and then you can it's just an additional benefit. This says, so they keep the cash value and the beneficiaries get the death benefit or something like that, or interest. Are you talking about this question, or are you talking about the last question? So they keep the one split dollar. No. So again, this one doesn't have anything to do with the beneficiaries at all. This is just about the policy itself. So when you have a benefit package, and I don't want to get too far into the weeds on this one because there may be like one split dollar question on the exam altogether, but what it has to do with is that the company will offer like a fancy whole life policy, probably maybe with like a high death benefit, maybe like a 500,000 or potentially even like $1 million whole life, which is a huge whole life policy, and they'll split the cost between the two. So the company will pay some of the policy, and then with a whole life policy, like especially like a big whole life policy, that cash value is going to grow. It's almost like dollar matching on like a 401k or something like that. But they're offering dollar matching or split dollar on a whole life policy. And it's an incentive for that employee, that executive, to stay with that company. Because again, if he's got this 500,000 or $1 million whole life policy, and it's like, okay, if you stay with the company, let's say 15 years or something like that, then we'll turn that policy completely over to you. So it's a big inducement to somebody staying with a company or joining a company, and he can save money on the premium payments. Well, he's splitting it. So yeah, they save money because the company is paying for half of it. They're paying for half of it. So and they're getting access to a huge whole life policy or permanent life policy. So that's why it's split dollar. And then again, eventually they'll have a written contract, and at some point in time they'll turn that policy fully over to the employee. It's just, again, it acts just like a 401k, where if you ever have a 401k and the company matches up to like 3%, but you also have to wait 3 years to be fully vested in the 401k. So if you leave before 3 years, you can't get access to that all of that cash value, whatever the company added into it. They keep it. The same with this split dollar, big whole life policy. If you stay the full 15 years, then after 15 years, you get to walk away with the whole policy yourself, and you own it, and the company over that time paid for half of it. So it's a big benefit. It's a big, huge benefit for high paid executives. And I have seen, again, that'd be like one question, split dollar. There's not going to be a ton of split dollar questions on your exams, maybe one. This is a health insurance question. An employer sponsors a group health insurance plan that covers, yeah, exactly. And it's an incentive that encourages them to stay with the company a long time. Yep. An employer sponsors a group health insurance plan that covers 85% of eligible employees, with the employer paying 75% of the premiums. This plan is classified as full contributory, non-contributory, voluntary, or partially contributory. This is a weird question, I must say. I think it's a lot of fluff. Bill's in there with D. I'm inclined to agree with you, but I don't always get these right. A wouldn't make any sense. B doesn't make any sense. C is nothing. So I agree with you guys. Say D, partially contributory. Yeah. So a contributory plan requires employees to pay part of the premium. Since the employer pays 75% and the employees pay 25%, it's contributory. Non-contributory plans have the employer paying 100%. Contributory plans require 75% employee participation. And just as a little bit extra on this one, they have to have 75% participation unless some of their employees have health coverage through their spouses with other companies. They can be left out or excluded from the 75% requirement. So if the spouses have coverage through their other spouse, they get better coverage or whatever, they can be omitted from that. But this is what was kind of weird, is the word partially contributory. Generally, it's just listed as contributory. So it's almost like they kind of put that in there to kind of throw you off the scent, but the answer is contributory. In field underwriting, an insurance agent notices information that may affect insurability. What is the agent's primary responsibility? Modify the application to improve the applicant's chances of approval. Report all material information accurately to the home office underwriter. Make the final underwriting decision and issue or decline coverage or guarantee coverage to the applicant if they appear healthy. All right. I'll put my glasses on, see that. B, hey, Natasha, what's up? B, that is correct. You report all the material information. The agent, so the role as a field underwriter, you're the first set of eyes that on a client. So the client may try to pull the wool or misrepresent something, but if you notice it or you see it, it's your job. There's a section for agent notes. You can override basically what they say. The agent's role in field underwriting is to gather accurate information and report all material facts to the home office. Only licensed underwriters can make coverage decisions. And that's wrong. There is no such thing as a licensed underwriter that I'm aware of. They don't have to have licenses. So sometimes these exams have a little bit of mistakes in there, and they're only designed to let me tell you the truth. But everything else about this is right. That is not right. There is no such thing as licensed underwriters. Can they sometimes be solicitors? No. They cannot. You can. That would be a complete conflict of interest to be an underwriter and a solicitor at the same time. That is a no. And underwriters aren't licensed at all. Companies don't want them to be licensed because they don't want to have the appearance of a conflict of interest. So no. So that's why there's no such thing as licensed underwriters. So yeah. No. That's bad. But good way to bring it up though. I like that question because I can act all upset and whatever. No, I'm not really. I'm just acting. I'm being dramatic, as my wife would say. My wife says, "Oh, you're so dramatic all the time." Well, maybe. I don't know. Yes, I can be dramatic. I have to somehow make this very dry content a little bit exciting. And I do get excited about some of this stuff. Well, I hope it helps you remember that's you're gonna be afraid to answer the question and be like, I'll be yelling at you in the back of your head. All right. Which of the following riders, we didn't cover riders tonight because it's such a short session. But riders are add-on to coverages. Jesus is already answering it. Which of the following riders would provide coverage for an additional insured without requiring evidence of insurability at the time the rider is added? Return of premium, spouse term rider added at policy inception, guaranteed insurability rider, or accidental death benefit rider. All right. So the kicker here is an additional insured. So Jesus actually has that. It's B, spouse term rider added. A spouse term rider added at policy inception typically does not require evidence of insurability for the spouse at that time, as it is underwritten with the base policy. The guaranteed insurability rider allows future purchases without evidence, but that's for increasing coverage, not adding other insured. So, again, when you're looking at the question, fully understand what it's asking for. So this one's talking about additional insured. I know it's very subtle. It's not talking about additional insurance. So guaranteed insurability would be adding extra insurance. This is adding an extra insured. So I think you guys have it now, which is awesome. So, and again, I'm not grading you. We're all trying to learn together. And I get them wrong every once in a while too, because I'll read the question wrong. So we have about 30 minutes or so left in tonight's session. Appreciate you guys hanging out. Which of the following would constitute an unfair trade practice of rebating? An agent offers to share their commission with an applicant as an inducement to purchase. An agent explains the policy benefits to a prospective client. An agent advertises insurance services in local media, or an insurer offers dividend options to policy owners. And I turn around and I see two correct answers. So if you guys want to share off of somebody, share off of Jesus and Scott, because they got it right. It is A. Rebating is offering to share commissions, give special favors, or provide anything of value not specified in the policy as an inducement to purchase insurance. It's prohibited in most states. So literally a $20 gift card to Starbucks is not okay. Like, you can give somebody a pen or a stress ball or, something like that, stationery, something like that, but not anything, even a $5 gift card to Starbucks. It doesn't work. Scott says you can do up to $100 in Oklahoma. So that's where it says most states. You got to know your state's overlay in these questions. That's good to know. I never heard that before. So $100. I always used to get cheesed off because the same thing applies to mortgages. And we had locally where if you went into a certain mortgage company, you could get like a signed football from, a Cincinnati Bengal or whatever. I'm in Southern Ohio, by the way, if you guys didn't know. And it always made me mad because it wasn't legal. And they literally advertised it on the radio, and I don't know how they got away with it. It was so frustrating. But that's good to know. Up to $100. Now, I wonder if you have to actually sign up for a policy or if you can get that just for doing an application. I wonder how you probably actually have to get a policy to get that $100. And as long as they do it for everybody, it's probably okay. I don't know. Good to know, though. A life insurance policy names the insured spouse as the primary beneficiary and their children as contingent beneficiary. The spouse and the insured die simultaneously in an accident. Under the Uniform Simultaneous Death Act, who receives the death benefit? It's divided equally between the spouse's estate and the children as contingent beneficiaries, the insured's estate, or the spouse's estate. I think you guys are saying B. There you go, B. That's what I'm talking about, B. No, you're good. Yes, the children as contingent beneficiaries. Okay, so it does assume the spouse died first. Well, let's see. Names the insured spouse as the beneficiary. Yes, correct. It does. So, in fact, let's break away real quick and go over beneficiaries. Hold on. Let's go over beneficiaries real fast. Make sure I'm going the right way. I was going the wrong way. Oh, there we go. Beneficiaries. All right. So here's basically how this works. That's also that scenario that was on that test question is called a common disaster. It's often called the common disaster clause. They called it the uniform, blah, 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 something or other clause. But I'm going to show you how this works. So we're going to say, and you guys might be thinking, man, this guy loves to draw stick figures. Yes, I do. I like drawing stick figures. This guy's got a slack jaw. What happened to him? My goodness. So this is the insured. Okay. This is the primary beneficiary. This is the contingent beneficiary. P, C. If the insured passes away and the primary beneficiary is still alive, the money goes to the primary beneficiary, not the contingent. The contingent is only there in case something happens to the primary beneficiary before the insured. Now, let's say in a common disaster, the primary or the insured dies and like they're in a car accident together and the primary beneficiary dies 5 days later. Under the common disaster clause or whatever they called it in the test, it is assumed that the primary beneficiary died first so that this money can now go to the contingent beneficiary or beneficiaries. So that's how primary and contingent beneficiaries work. So I'm not going to do my normal thing. Oh, I just got some great news. Travis passed his exam. Heck yes. Man, that is awesome. Don't know his score yet. Just know that he passed. That is great. Man, I'm stoked. I'll miss that guy. Yeah. Travis was he just no, it doesn't. That's a good point. The score does not matter. It's not any there's no bearing on how you're going to be as an agent based on your score. You're not going to walk around and go, I got a this. The only person that talks about what he scores on a test is me because I teach you guys. So I don't want you guys to think that, I scraped by, and now I'm trying to teach this stuff to you and I don't even have a good grasp of it myself. That would be demoralizing. So so the only person walking around bragging about his score, that's me. I wear it as a badge of honor so that I can say, you don't want, I don't know, it'd be pretty bad if your teacher, wasn't good at test taking. I mean, that would not be awe inspiring. But Travis's issue, and I'll, he will probably come back and share at some point. But he took the exam more than one time, just isn't a good test taker. And So we really had to work hard on, um, yeah, it would be. I don't know. If you were in an agency and you were talking about your test score, they're just going to roll their eyes at you and say, "Who cares, dude? Show me your paycheck." That's what they're going to want to see. But yeah, so in this case, man, it's like a huge weight off. Yeah, I'm excited for him because he and I've spent a lot of time preparing. So he is like he's a new trophy for myself that we worked very hard. So anyway, let's get back into the content, and I'm sure I'll have Travis come back and share his experience because it's a vast experience, and he did earlier a little bit. He shared some good information. I thought he would be the right person to do that, and so he shared some good things. So let's talk about beneficiaries. We only have about 20 minutes left in tonight's session. So revocable beneficiary can be changed without the consent of the beneficiary. So as the policy owner, if you want to change beneficiaries, you can do that willy-nilly. Has to be done in writing, has to be done officially. But if they're irrevocable, they cannot be changed without the beneficiary agreeing to it. I'll tell this explanation really quickly. I'll tell it in 2 minutes. So this guy is Mr. Moneybags. Okay, he made a lot of money before he met his wife. This is where we come up with an irrevocable beneficiary. We're going to call his wife Trophy Wife. He's got a lot of money. She's marrying him. He wants her to sign a prenup. Yeah, I'll explain that when I explain this. Totally. Prenup. So Mr. Moneybags doesn't want her to have access to the money he made before he met her. Wants her to sign a prenup. So she says, "Okay, Mr. Moneybags, I want a $2 million life insurance policy, and I want to be an irrevocable beneficiary, and I'll sign your precious prenuptial agreement." That means this money is in a lockbox for her when homeboy kicks it, right? So this is kind of her safety net, her guarantee. Okay. So she signs the prenuptial agreement. Now she will have, some access to money that he made while they're together. But let's say after 10 years, tragically, they get a divorce and he marries a new trophy wife. I always make her taller. I don't know why. I'm weird. So they're divorced and he comes to her. He's like, "Man, I'm 10 years older. I can't get this same policy anymore. My health has failed a little bit. It would cost me way too much money." So he goes to her and says, "Hey, honey, would you please allow me to put my new trophy wife as the irrevocable or the beneficiary of this life insurance policy?" And she says, "Nah, baby, nah, pound salt. I'm irrevocable. That was the whole point. Ain't going to sign it." So he's like, "You know what? What if I give you $250,000 today to sign away my rights to this policy?" And she's like, "Well, you're not in that bad of health. So let's wait. I'll go ahead and take the 250,000. So he can add the new trophy wife to the $2 million policy. She signs a prenuptial agreement, saves him money. He could live another 10 or 15 years, so she takes the money and runs right away. So that's how, and so all that. Someone asked me one time, "Why would you have an irrevocable beneficiary?" And that was it. So I'm glad I answered your question. Now, there are some weird state-specific things around beneficiaries. Okay, I'm not going to confuse you. I'm not even going to say what it is, but you might need to learn your state-specific things revolving beneficiaries. But revocable and irrevocable is everywhere. Then also know that minor beneficiaries have to have a guardian to manage the proceeds. You cannot leave your money to a minor. they have to have someone to manage the proceeds. It says court appoints, but you can also have that as part of the policy. You can name who they are. Now, designation by class. I knew the answer to this question when I took the exam, but I did not understand the answer. Now I do. And so I'm going to give you guys a leg up on designation by class. So when someone writes in their life insurance policy that I want my beneficiary to be my spouse or my children, instead of naming a specific beneficiary, you do it by class. You could even be not have a spouse. You could have, a life insurance policy, and you're like, well, I'm going to have a spouse one day. So you put my spouse or my children. Maybe you only have one child, and then you end up having 3 children, and you want your children to all share in your life insurance equally. Well, upon the death, it will go to their spouse, their current spouse, and whatever children they have at the time. No, it's your current wife, unless your previous wife is an irrevocable beneficiary. That would trump. You couldn't really do that. So this is a way to write it where you're only going to cover your current spouse. The previous wife will not be able to have access because she's not the current spouse. So that's why someone does designation by class. And then again, it covers, yes, she says, and does that cover current and future? I think that's the advantage of that. So it is the advantage. The advantage is, you don't have to go back and change your beneficiaries on your life insurance. It's going to cover whoever's on it at the time, or whoever your children are at the time, whoever your spouse is at the time of your death. So designation by class will cover that. Yeah, that's exactly right. So I knew the answer. I knew that designation by class meant my spouse or my children, but I didn't understand what it meant. So now, not only do I can get the answer right, I can teach it to you and help you get the answer right and understand what the heck they're talking about. So there you go. All that for that. And I heard from Travis during that. So that's exciting. And honestly, that's another point that I want to make. I want your guys' information. I want to keep up with you guys. I want to hear from you when you pass your exam, and we're going to say that. We're going to call it out. We're going to say when you pass your exam. But in the event that you do fall short, I never, ever, ever use the word fail. Don't even like saying it right now. Fall short. If you fall short, you email me, you send me your transcripts to your exam, and I will create you a targeted study guide covering the areas that you fell short in or that you were weaker in. We're in this together, okay? Medicare Part A primarily covers which type of expenses? Hospital inpatient care and skilled nurse facility care, routine dental and vision care, prescription drugs, or physician services and outpatient care. And Natasha already jumps in. She's got the right answer. Guys want to copy off of Natasha. It is A. It's called hospital insurance. Medicare Part A is also known as hospital insurance. Inpatient skilled nursing facility care for a period of time, hospice care, home health care. Medicare Part B is more regular health insurance that covers physician services and outpatient care. Physician or D is tricky, but the key is outpatient care. So yeah, there you go. Because again, the thing to remember when you're talking about Medicare Part A is that the other name is hospital insurance. So really everything that deals with hospital stay is Medicare Part A. But if you want something more like traditional health insurance, then you're going to want to have Medicare Part B involved as well. And then, of course, D equals drug. And that gets either added to A or B. And then Part C, it's already automatically included in Part C. An accelerated death benefit rider allows the insured to access policy proceeds under which circumstance? Unemployment or financial hardship, terminal illness diagnosis with limited life expectancy, retirement at age 65, or voluntary policy surrender. And always I say this about the first person that gets it right, copy off of them, and it was Scott. It is B, terminal illness. And for a little bit of extra credit, what is the life expectancy of someone with a terminal illness? It's a specific period, blank to blank months for a terminal illness. Within 2 years. That's good. Yeah. Also, it's 12 to 24, or I'm sorry. Yeah, 12 to 24 months. So 1 to 2 years life expectancy is considered a terminal illness. So within 2 years is also a way that you might see that as well. Oh, yeah, it says it right here. Accelerated death benefits allow terminally ill insureds, typically with 12 to 24 months to live, life expectancy, to access a portion of their death benefit while still living for medical or living expenses. And it still leaves some death benefit, but it gives them some of their death benefit up front. And always keep in mind, this is on whole life policies, not term life policies. They're not going to give you your death benefit ahead of time on a term life policy. But it's a rider. It's an add-on to a policy. So I'm not, you know what? I'm not going to say that. There could be a term life policy out there that has an accelerated death benefit rider. I just don't know anything about it. So it doesn't matter, really. For passing your test, it doesn't matter. An insurer delays payment of a valid claim without reasonable cause. This action may subject the insurer to license suspension, premium refund requirements, penalty, interest, and potential bad faith damages, or criminal prosecution only. So this question has some really good things in it. No, it's not A. It's not B. It's not D. It's C. Penalty, interest, and potential bad faith damages. You guys all got it there at the end. Unfair claims practices may include, I'm sorry, let me read this again. I'm getting tired. So, unfair claim practices, including unreasonable claim delays, can subject insurers to penalty, interest, consequential damages, potential bad faith claims, which may include punitive damages. So there you go. Which of the following is an example of the unfair trade practice of churning? Explaining different policy options to a client, providing policy illustration to prospective clients, recommending frequent policy replacements to generate commissions, or offering lower premiums to attract new clients. And if you're copying off somebody, copy off Jesus. Recommending frequent policy replacements to generate commissions. That's within your own company, by the way. So the churning is the practice of encouraging policy owners to replace policies unnecessarily for the primary purposes of generating new commissions. It is an unfair trade practice that harms consumers. So for a little bit of extra credit that gets you nothing, if you're replacing a policy for a client of another company that doesn't benefit them, what is that called? As a different word. No. There you go. Scott's got it. Twisting. Twisting. So the way I explain this is if you have imagine a little old lady and she's holding her policy that she has in her hand currently, and you grab her arm and you twist it behind her back, and you make her, well, not make her. That's a little more violent, but yeah, if it's physical, it's coercion. So if you threaten violence, I'm talking metaphorically twisting her arm behind her back in order to change policies. But yeah, you're right. So I didn't understand the question. This question? Example of unfair trade practice. So unfair trade practices are churning, which is a way to explain churning is you're basically you're churning up new business with your own existing business, but you're not doing it to help the client. You're doing it to just get a new first year commission. Because when you do insurance policies, you'll get residual income off of life insurance policies. But if you get bigger ones, if you do like a new policy, so you get a higher one. So if you're constantly replacing policies for your existing clients to get a new first year policy commission, that's churning. And then twisting is somebody else's policy, another company's policy, and the little old lady's been paying on it for 10 years, and you basically, I say twisting your arm, but actually Scott is right. You don't want to say that. You're basically trying to tell them, you're twisting the facts, saying my policy is better than that policy, not really explaining the fact that starting over an insurance policy means you have to start over the new contestability period. You may be forfeiting cash value on a whole life policy. There's just a lot of problems with changing someone's policy, twisting them. And then coercion is like, either you buy this life insurance policy or I shoot you in the head. That's coercion. So yeah, or I'll twist your arm. All right, I'll do a couple more. We got we're right at the end. Yeah, see, it may not meet the insured's needs. That is the number one responsibility of an agent, is to put the insured or the policy owner's needs first. An insured becomes totally disabled at age 50 and has a waiver of premium rider on their life insurance policy. Which statement is correct? Cash value accumulation stops during the period premiums are waived. Only the base policy premium is waived. Rider premiums must continue. The insurer will waive premiums immediately upon proof of disability. Premiums are typically waived after a 3 to 6 month waiting period following the onset of total disability. And I turn around and I have all correct answers so far. Very good. Very good. Very good. Waiver of premium riders typically include a waiting period, commonly 6 months, of continuous disability before premiums are waived. Once the waiting period is met, all premiums, including riders, are waived and cash value continues to accumulate. Very good. Very good. So, yeah, that's called absolute language. So this says the insurer will waive premiums immediately upon proof of disability. So that's extreme language. It's not likely to be correct unless there's a law about something, then maybe that would be true, but we know that's not. But I was going to bring that up earlier, so I'm glad you mentioned that. We'll look for that absolute language on the one more question that we're going to do. A beneficiary is due $250,000 from a life insurance policy death benefit. The beneficiary selects installment settlement options, paying $2,500 monthly. The excess death benefit held by the insurer will Earn no interest. Earn interest that is taxable to the beneficiary as ordinary income. Be held in a trust without interest. Earn interest that is paid tax-free to the beneficiary. And I turn around and Jesus liked the answer B so much he answered it twice. So nice he answered it twice. And I believe you're right both times. So now this is a kind of a little known thing, or I don't know, seems to evade a lot of people. When death proceeds are held under a settlement option, the principal or the death benefit remains tax-free, but interest earned on the retained proceeds is taxable to the beneficiary as ordinary income. Now, also realize that anytime a death benefit to a beneficiary is paid out as monthly income, it's taxable always. So if it's a lump sum payment, that's why I kind of think like monthly payment proceeds from a life insurance policy is kind of a jerk move. Just give it all to them. There's other ways to do that. They could literally have. Now we haven't talked about them tonight, but they could literally have the death benefit fund an annuity, and then the annuity could pay income, and it wouldn't be taxed. But just doing it as a straight like income option, it's a dick move. Like it's not great. So anyway, I'm gonna end there. It's 10:58. I'm off at 11. So I've really enjoyed you guys. Make sure I have your email address